All right, hello everyone. Welcome to a video with Roxanne Esparza with Golden Valley Real Estate Group. Today I'm joined by Allyn. He is with Agape Mortgage, and he will be sharing some knowledge about the FHA loan process and any other questions regarding the loan process in general. These videos are meant to be educational, and if you have any other questions, then feel free to reach out to one of us as a professional so we can help guide you through that process. So we'll start with an introduction from Allyn and then we can move forward.
Well, thanks, Roxanne, for having me on. So my name is Allyn Medeiros. I've been in the mortgage finance industry since 2002, so a few years. I literally have helped over 1,000 people with home loan financing here in Kern County, and I really take a personal sense of satisfaction, really helping a lot of families make good financial decisions just by really learning more. And having resources like this that you're providing right now, Roxanne, is crucial. I mean, I think people there's a lot of fear. The things that we talk about all the time are if we can help somebody make a better decision and they feel comfortable with that decision, they're going to be committed to that decision. And ultimately, the education really is what helps with that. So we lend in California. Our parent company is Sierra Pacific Mortgage, but we do business locally as Agape Mortgage. And I do have a production partner in the office who is fully bilingual Spanish, English. And we work together as a team to help, first-time home buyers, move-up buyers, and investors purchase real estate and refinance real estate when it makes sense.
All right, thank you so much, Allyn. So yeah, we'll go ahead and start with a couple questions that I often get for those first-time home buyers. So for first-time home buyers, it's a very interesting process because at first they might not know much of the definitions related to real estate. They have many questions. They
Mhm.
somewhat feel insecure, but this video will kind of help answer some of those questions that maybe many of you might be having. So first off, we're going to start with a basic question. Can you explain the FHA loan and the process surrounding it?
Sure. So FHA is the Federal Housing Administration loan. It first came out actually after the World War II, and it was designed to house America after the war. And it allowed for financing that was designed to get people into homes. Now, since its inception, it's really made a lot of changes, but it's really been focused on putting less down payment in order to get into a property. And it's not just a first-time homebuyer loan, but it's widely used. It's designed really for your owner occupancy home. So it's not designed for rentals. It's not designed for investments if you're trying to build a portfolio. There are some little tricks, though, that you can use the FHA, which we'll talk about in a little bit. But the FHA allows for a minimum down payment of 3.5%, but that can also be combined with the down payment assistance program. So we do have options for up to 100% financing and then potentially financing a little bit of closing costs as well. So when you look at FHA, don't think of it as a first-time homebuyer loan, but it does offer less money down. The next thing is FHA itself is designed to really protect the consumer. It allows the appraiser to make sure that the house passes all health and safety requirements. So they're a little bit more thorough on some of the investigation of the property for inspections. And then lastly, the interest rates are typically lower. And the reason why is because that particular pool of money is actually a bit more robust, as well as having mortgage insurance on all the loans. So if you're putting down 3.5%, you really don't have much in the way of financial, I guess, obligation to the loan. So they have to have something called mortgage insurance, and it protects the bank in case of foreclosure. The best way to explain it is think of like gap insurance when you're purchasing a vehicle. So say you bought a vehicle for $25,000 and the moment you drive off the lot, it might drop to say 20,000. So there's a $5,000 gap. If you got into a car accident, as soon as you got off the lot and the bank had to total it out, they may only give you 20,000. So you may be responsible for $5,000 for that difference. So that gap insurance covers that difference. And mortgage insurance can kind of be seen that way, and it provides that protection for the bank. Um, with regards to FHA, I want to make a couple of key distinctions. One is that it allows for a lower credit score as well. So if you want to use a down payment assistance program, generally the bottom starting point is around 640 as a score, but FHA will go as low as 580. but you need to have a down payment typically of 10% or greater, and you need to have other compensating factors. So it's more forgiving, if you will, as far as guidelines, and it allows for higher debt to income ratios, meaning you can have more obligations monthly, things that you pay out on monthly. This could be credit cards, student loans, auto loans, personal loans, plus the mortgage payment. What they do is they basically add those together and divide by your total monthly income. And it's just more flexible for those things. Additionally, if you've had some credit challenges in the past, say collections, or you've had some other issues with slow pay on items, FHA is going to be more forgiving on that. You just need to show that you're no longer facing that hardship and you're back on track, if you will, financially.
All right, thank you. And so another question that maybe ties into that as well is you can use FHA more than once, correct?
Oh yeah, actually, I'm going to be posting a video about that on my own channel
Oh,
here very shortly because I recorded it. But basically, yes, FHA can be used over and over and over again, but you cannot have any two FHA owner-occupied loans at the same time. There is an exception to the rule. If you are purchasing a property that is 100 miles or greater away from your existing primary residence and you're going to move into that property, FHA may allow you to buy a second home using FHA financing with just the 3.5% down.
all righty. Yeah, think that's something that maybe not many people might know, is
Mhm.
that they just think that, oh, I can just use it once.
Yeah.
But I feel like that's something that can help other people to buy as well.
Well, here's something. I think that there's some misunderstanding about first-time homebuyer definition too. So within the lending world, the definition of a first-time homebuyer is you have not owned any real estate in the last 3 years. So let's just say, for instance, in 2020, you purchased a house and you sold it in 2022, right? You stayed in it 2 years. Well, technically speaking, if you go 23, 24, 25, you could buy another home using first-time homebuyer benefits or down payment assistance in 2026. So it allows you that opportunity and flexibility as well. But you would need to check with the lender specifically about your timelines if you want to use down payment assistance. But it doesn't, there's no wait period if you put the 3.5% down. So if you decided to buy after you sold a house and you want to use FHA again, you can use it right away. It's just if you want to use the first time homebuyer benefits.
I see, yeah. And so, yeah, that's really, I feel that that's something really important to know as well
Mhm.
for anyone that maybe wants to buy another property or a home. So, okay, we'll go to the next question. So, what's some documents that are needed for pre-approval?
Sure. So I want to make a clear distinction between a pre-approval and a pre-qualification because I think that those terms are used interchangeably, but they're really not the same thing. So pre-qualification would be if you told a lender, this is where I work, this is how much money I make, and this is how much I have in the bank. And they go ahead and do maybe a credit report. If the credit score meets the requirements, then they may say, okay, you're pre-qualified up to this amount. Okay. Well, the difference between a pre-qualification and pre-approval is verification. So when we look at verifying information, the needs list that I'm going to give you right now are the things that we're verifying. We're basically taking the information that we're requesting on the application and we're verifying and validating. This becomes super important, and I'll tell you the reason why, is that some people really don't know what their numbers are on their pay stubs and their, bank statement direct deposits and what they see on their W-2s. They really don't even know how to read their W-2s, to be honest with you. So we look at those documents, and once everything's been verified, we can stand behind the pre-approval as long as nothing changes on your credit and your income does not change, you don't quit your job. And there's going to be a list of do's and don'ts that we'll talk about in a little bit, but here's the basic list. You need to cover the last 2 years of employment history. So if you switch jobs, totally fine, as long as you had no gaps greater than 3 months between the employment and you have proof that you've worked in the last 2 years. Now, it doesn't have to be the same field if you switched and maybe were trained for another position, but we would look at the last 2 years W-2s. We're going to be looking for the last 30 days of pay stubs, the last 2 months of bank statements, a copy of your photo ID, and then also we would ask for an authorization to be able to review your credit and your assets.
Alrighty. Yeah, that I feel that that's also something that maybe those people that are in the process or even thinking of, they can start to kind of obtain those documents because I know that sometimes it may take a little bit longer for some. So yeah, that's very important
I
notes.
just want to interject one thing that's really important is a lot of times people don't keep paper copies these times because everything is digital. So what I recommend is create a folder on a desktop, not just your cell phone, that you can save documents, specifically tax documents like your W-2s, and hold that in the folder and just keep building on that because it'd be easy to access at a later time. Pay stubs, generally speaking, everything is online as well. Most lenders will accept PDF copies, even images of these items if they're clear and they can be converted to PDF because there's a lot of AI technology that reads these documents. So it's important to have that stuff accessible. Now, one other thing is that I didn't talk about this, but if you're self-employed or you have some type of independent contractor position or title, for example, you drive Uber, or for instance, you are working in insurance sales and you received a 1099. So that 1099 does not take any taxes out or anything. They're giving that to you so you can report Schedule C self-employment income. Now, if a borrower is actually self-employed by owning a corporation or owning some type of partnership and they have a shared amount, then we can look at the tax returns and evaluate the income based off of that. So you don't have to be just a W-2 employee to qualify for financing.
Alrighty. So, and for in the pre-approval or pre-qualification process, for those married couples, their partner, when they're pre-qualifying as well, does that partner's credit count when applying? That's another question that we often get.
Sure. So in California, we're considered a community property state. If you look behind you, what you can't see, which I can see, is the Golden State Bridge. So it's a great, like, iconic California thing, right? Um, as a community property state, if you're legally married in the state of California, we need to disclose the partner, spouse, if you're a married couple, their credit. It doesn't mean they need to go on the loan, but if they have any debts, we need to qualify with those debts. Okay. So for example, let's just say one partner has, you know, um, most of the income. The other partner has no income, but has debts. We would have to qualify the person that's qualifying for with the income with the debts of the other person. Now, if they both go on, that's totally fine. But sometimes they don't want to go on the loan. Now, they're we're okay to move forward on that. Now, are we going to talk anything about other types of loans tonight, or is it just going to be exclusively FHA?
So we can, yeah, focus on FHA, but did you want
Okay.
to mention some
All I
things?
was saying on the conventional loan, though, we don't necessarily need to disclose the other person's credit or debt. So it's a different set of criteria. And that's just important to know. If you were to come talk to me, we would actually do what they call a discovery meeting. There's no expectation on our part or anything you should expect so much as learning. It allows us to make good decisions together. And I'll just put everything out in front of you and say, this is where we are now. Here are the things that we need to either work on, or you're ready now. Here's what we need to do next. And in that process, I can evaluate whether or not you need to disclose another person's debts or use their credit, or not. And that's kind of why it's called a discovery meeting. We don't want you to feel committed to anything. And we would do what we call a soft credit pool. So it's not going to impact your scores in any way, but allows us to do proper planning. And then you're not forced to do anything. I think people really freak out when they're in situations where they feel like they're pressured to do something. And once they start going down a path, they feel really, really guilty if they cancel or they stop. And I'm like, no, you need to do what's best for you. Emotionally, this is a big decision. I get that. And I don't want people to feel like they're pigeonholed into like they have to do this. But the more you know, the better it's going to be. And the more it sits well in your heart. And I'm being honest about this. Lenders aren't supposed to talk about their heart, but I mean, you have intuition. Like, if something doesn't feel right, you need to stop and you need to regroup and ask questions because If you feel later on that something goes sideways, you're going to be like, I knew it. I should have stopped. Do you know what I mean?
Right.
And I want these potential applicants to really have an understanding of why we do things. And then once we get to that next step, they can make better decisions.
Right. And then I also encourage them to ask as many questions to
Oh,
learn,
of course.
right? I feel that that's also something.
I always tell people like, you know what? Hey, we live by these things. It's got a notes app. Just write all your notes out. And if you have questions, like bring them. If you don't have them at the time, ask them later because you're always going to think of something once you start talking because there's all this information that you're gathering. You can't always absorb it all at once. So I would say after we're done, kind of do a debrief, ask those questions so we can get you the right answers.
Right. All right. And now another question we do get is about retirement accounts like 401k. They do ask if are they able to use money from their 401k as down payment.
Sure. So the short answer is depends. I say that because not every plan that you have for a 401k will allow you to take a loan out. But if you do decide to liquidate and take money out of that 401k, usually that's a one-time event and you will have to pay taxes on it if you withdraw. But if you're a first-time home buyer and this is the first time withdrawing funds, they may waive a portion of the penalties, but you may still have some tax to pay. And the reason why is 401ks are considered to be pre-tax dollars, meaning the money went into that account without having taxes paid. So when you withdraw the funds, it's taxable at that time. But I always encourage people, talk with your plan administrator, talk to your tax professional because we're not tax professionals, although we know enough of the rules to be dangerous.
I know, right? Like it's always hard that sometimes we have the knowledge, but then we're like, oh wait, that's not my
Yeah,
lane of expertise.
exactly right.
Advice on that. All right. So another question to kind of go into more of the approval process. So how is the process like how many days does it take for the loan approval and closing usually?
So there's two phases to that. Let's say, for instance, Roxanne, you had advised someone to come speak with me. We scheduled an appointment and they have all of their documentation, right? They have their W-2s, they've got their pay stubs, they got their bank statements, the credit looks in line. Because I'm a direct lender, I can issue a pre-approval right then and they can literally start shopping. But if there's missing data points or there's something I need to get confirmed, for example, I had a client earlier in the week, and this particular borrower had a lot of overtime. And the overtime is really important for this family because I need it to qualify. Well, unfortunately, the base income that's used for hourly was not enough. So now I have to contact the employer, get a full written verification of employment. Once I get that back, I can then average the overtime and then I can come up with an answer. So until I get the information back from the employer, I can't really finalize the pre-approval. If you're a salaried employee, meaning you get the same paycheck every month, or you get the same paycheck every 2 weeks or every week, however you're paid, and it's consistent, then generally speaking, we're going to have no problems with the pre-approval. And if everything aligns up, it'll be the same day. Now, getting into contract and closing. That is set by the real estate professional. Really, if you can find a residence, you get into contract, you negotiate the terms, we communicate very effectively to find out to make sure the numbers work. Then once you're in contract, we will do a hard credit pull. And at that point, we have technically 90 days on our pre-approval, if you will, because the credit is good for 90 days. But most of our escrows are 21 to 30 days, meaning the time you get into contract, the time you get keys will be within 21 to 30 days.
Yeah, and then they also in the contract we can also kind of negotiate that. Obviously, the lender you do need the time to make sure that everything is set and ready at the very end. And so that's also something that in the contract it shows up, like how many days the
Yes.
buyer wants to negotiate for that as well. All right, so another question for that pre-approval process, pre-qualification process. While they're shopping and let's say that their loan amount maybe doesn't meet a certain property type that they're looking for, And are they able to change the loan amount or maybe the type
Absolutely.
after
Yeah.
applying?
That's a really good question. So when we sit down and talk, part of my conversation is what is your budget? Like, what are you comfortable paying? And if they tell me a number and I work backwards from that number, I'm going to tell them a sales price. At that point, as they start looking, this invariably happens. Somebody goes out and they look at a house and like, okay, I'm pre-approved for 350,000. And then they see a listing for 360. So they go look at that house and it's just perfect. It checks off all the boxes. Well, if we have enough value as far as like how much income is coming out and the ratios make sense, then upping the sales price is not normally a problem. But I always ask once we set a limit that you buy below that. If you do go above it, we need to have that conversation before you make the offer. So that way I can update the pre-approval. And then if you get the offer accepted, we can move forward. So yes, the loan amount can change. So don't be, completely stuck at a particular pre-approval amount unless I tell you this is the max, 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 because this is really going to not approve if we push it past this.
Right. And then also another question to kind of back up that question I just asked, is someone also able to maybe apply with you after you've already applied?
Are you talking about adding additional borrowers?
Yes. Like
Oh, yeah, yeah, for sure. So in some situations, I'll give you a good example. Let's just say, for instance, somebody's trying to qualify for a house for $400,000 and their debt to income ratios really only support, say, 350,000. But something we don't know, which I can't document, is that they're going to have a roommate. This person's going to pay $800 a month. Okay. And they're going to rent a room, share expenses. I can't use that in my qualifying. Okay. But this house that can help you purchase. You can still use the 3.5% down in FHA. And as long as their income and their debts adds additional income for your qualifying, we can certainly do this. And I did that last month actually with a family where the brother actually co-signed with the sister in order to help her qualify because the sisters had a long-term roommate that they actually been renting an apartment together, but they want to buy a house and she's going to continue to rent and pay the same amount. It's just that we can't use that qualifying rent for the FHA loan at this time.
right, I see. Yeah, I think yeah, so we do get that often with those buyers that maybe need a little bit more in their amount for purchase price. And then that's something that that family or those borrowers can also talk about if that's good for them as well. And I'm sure you also kind of let them know how the situation would play out and what that means for them financially as well.
Now that you brought that up, let me bring up another point. So FHA, as I told you, is more flexible, right? So one thing that FHA does allow is you can have multiple borrowers that are going to live in the house. They don't have to be married. They don't have to be related. But the one thing you need to know is that since they're all going on the same loan, okay, they're contributing all income. We'd have to contribute all the debt that they have and put that all together and qualify. If something were to happen to the relationships for some reason and somebody leaves, now they're tied on that loan. And then they also have the financial obligation. So that's where it kind of gets to be a little bit difficult, but it does happen. So I've seen situations where they're engaged to be married, they buy the house, 5 months later, it blows up, and all of a sudden, that person moves out and they're stuck on the loan. They, haven't had the house long enough to refinance it. So it got a little bit hairy, if you will. So we have to have those conversations up front so nobody's in surprise and shock.
Right. And that's, yeah, that's something also that they should keep in mind because that does commit you in a way as well financially as a co-signer. Another question that we can cover is about understanding those monthly payments that and once let's say once you pre-approve, pre-qualify someone and then you show them their letter and the numbers. Can you explain some of those numbers that do show on that form?
Absolutely. So let me see if I can pull up a graphic that will help us to kind of see this.
Mhm.
So when we go through and qualify, let me go ahead and blow this up a little bit. I'll do a screen share here. So this example that I'm going to share right now is for a $400,000 purchase, which is right around the median income here in Kern County right now, or median sales price, excuse me. When you make a payment, you're going to be making a payment on principal, interest, taxes, insurance, and mortgage insurance on all FHA loans. So they have this little, they call it PITI, MIP, so PITI MIP. And it's basically principal, interest, taxes, insurance, and mortgage insurance premium. So this is the example. If you had a $400,000 purchase, if you put 3.5% down, you'd be financing 96.5%. Your base loan amount would be $386,000, but you have something called a mortgage insurance premium finance. So you would add $67.55. So total borrowed amount on a $400,000 purchase price would be $392,755. If you had a sample interest rate at 6.25%, just the principal and interest on the loan would be $24.18. But then you would have to add in the principal, or pardon me, the taxes, insurance, and the mortgage insurance premium, and that's an extra $742. So your total monthly payment would be $31.60. Okay. So every single month that you make a payment, it includes the property taxes, the insurance, and mortgage insurance. You're not making separate payments to those things. One thing to understand is that that's not the only expense. You're also going to have maintenance expenses. You should have money set aside for repairs and other types of things. Maintenance also includes, the cost of gardening, any things that come up in the house. It is important that you do maintenance because you're a homeowner then. And other things that you have to think about is in that process of being a homeowner, you're going to also have different types of things with regards to utilities. So your utilities will be based off of whether or not the property is efficient. If it's a newer property, the efficiency standards might be different. If it's an older property, but maybe has other energy efficient upgrades like new windows or newer roof, the property's been sealed properly, the HVAC system is newer. Those are all kinds of things that will improve the overall monthly expenses that you have for maintenance. Now, one thing I can tell you is that you, being the real estate agent in the field, will be able to better advise them when they're looking at property on what you see, and what you've actually asked the listing agent about the property. Something I didn't include in here are monthly ongoing expenses, like if they have solar. So solar is very prevalent in Kern County. About 1 in 3 homes have solar on them. And if it has a solar lease, it's a fixed payment typically. And that's typically going to be lower than what your utility would be if you didn't have the solar system. But if it's a loan, you're going to have to take on that payment. And as long as those payments make sense and you don't have what they call a true-up or an additional bill to cover what the solar didn't cover, then your expenses are pretty fixed and it helps out quite a bit. And the last is what they call a PPA, which is a power purchase agreement. And that's basically like a utility statement that you would pay PG&E anyways. It's just at a lower cost. And it's typically pretty good. But yeah, does that kind of answer the question that you had
Yeah,
on?
yeah, that does cover it because yeah, those are the just the main components of that. And then also you did cover more about like utilities and also solar. And yeah, those are also things to take into consideration.
Mhm.
Also, what about if you're looking at homes and let's say a condo? How does HOA also affect the financing of a loan?
You're coming with great questions, Roxanne. So an HOA is a homeowners association, and a condo is a different type of property. So I'm going to kind of draw a line in the sand to explain the differences between types of property and how FHA views it. So the most traditional home would be what they call a single family residence. It's typically built with a foundation, you have it framed with wood, the property is actually built from the ground up. In those situations, you're not physically attached to anything else. Now that attachment, sorry, my AI is doing this weird thing. So
Oh,
um, that attachment itself to another unit is what changes the type of property. So you might have something called a planned unit development, and that is where you have multiple units tied to each other, but they're independent properties. Whereas a condo is owned, sorry,
oh, no
you're getting
worries.
this locks into
It
place,
looks like
otherwise
it.
it's going to do all this crazy stuff. So A planned unit development is treated like a normal single family residence, and sometimes they have an HOA. So HOAs are normally designed for other benefits in the community. It might have a pool, it might have a club center, it might have, a gated fence area for, playing. It might have just a gate at the residence, meaning you have to have a security code to get in, or you need to have a clicker to get into the community itself. Those you pay an extra fee for. Now, condos are different. Condos are, let's just say there's 50 units in there. It means you're one of 50 units. So you might be unit 6 of 50. And those, they have an HOA, Housing Association, Homeowners Association, and they have expenses that are paid for by those monthly dues. Now, it's really important because condos have higher levels of lawsuits. So the thing that they always look at is litigation, and that's why we have to evaluate whether or not any particular owner owns any more than, say, I think it's 40%. So there have been situations, where the investors themselves have bought lots of units, and when they did that, they wind up controlling the HOA. So the evaluation is designed so you don't have that. We want to make sure that every person that owns a property within the HOA has their vote make, some impact. So, and the third type of property is what we call manufactured homes or mobile homes. They are different. A manufactured home, okay, is a house that is built and it's put down on the property on stilts, but it's actually permanently affixed and it will not be moved again. Now, a mobile home, you still have the axles on there, which basically means that you can be towed away and it's mobile. And those are not taxed as real estate, they're taxed by the DMV. So you can typically finance FHA loans for your standard single family residences, your PUDs, planned unit developments, and then your manufactured homes. But condos need to go through an additional review, and mobile homes are typically not financeable through FHA.
Right. All right. Well, thank you for that breakdown. Yeah, I feel that that's also something that maybe not many people know of, and it's really important when you're in that process of talking with your lender and you're shopping that your realtor, such as myself, you kind of investigate the property and the home like in entirely. Like that should be the realtor's job, and you get a good realtor, then just make sure that they're doing their due diligence and doing all of that research for you and they represent you to the fullest extent.
Yeah. Just ask a lot of questions because it's better to do that before you're committed, right? And if the property's not going to meet the requirements of the loan, they're not going to finance it. So it's better to ask those questions up front.
Right. All right. Well, thank you for that again. And now, once you get pre-qualified, pre-approved, how do you communicate through that process? Do you communicate maybe weekly or kind of every other day with?
So frequency is based off of milestones. So initially, the conversation will be, hey, how are you doing? How's the search going? If they find something, their feedback would be typically from the real estate agent because the agent's going to call or text or email, hey, we found this property. Here are the specs on it. Here's the sales price. Can you give us an estimate? If there's anything specific about the property that we need to know, meaning does it have solar? Are there any open liens? Is there anything that we need to address, an HOA? Then we would need to ask those questions. Once we get under contract, you'll typically be communicated with about once a week, but the milestones are the big things. Your loan has been submitted, the appraisal has been ordered, the appraisal's back, we have full loan approval. Here are some conditions we need to request for the bank to be sent. And then once that's completed, you'll sign something called a closing disclosure, and that is the final disclosure before you get to your final loan paperwork that's signed with a notary. And once those are signed, typically it's about 3 to 4 days, and you send in your final funds for closing, and at that point, you're ready to close. And when we close, you get your keys.
Right. And yeah, throughout that whole process, again, your realtor should also be helping you navigate that whole
Right.
process, explaining it, kind of future pacing you and preparing you for the next step. So that way you're not maybe like, oh, what's next? Or, oh, what do I need to do tomorrow or like in 3 days or 17 days, because
Mhm.
there are also different deadlines that need to be met as a buyer as well. And so let me look at the other question we have regarding and now savings. So what would be an amount that you would recommend for first time buyers or also just buyers in general, looking to use FHA or also maybe conventional as well?
Sure. So general rule of thumb is you're going to want to have at least 3.5% to 5% available for down payment, plus another 3 to 4% for closing costs. So the down payment is applied towards the purchase of the house, and you take a smaller loan amount because of the down payment. But your closing costs are expenses for borrowing the money, inspecting the property, and going through the process in California known as escrow. So those fees are one-time fees, and it's something that you have to account for. Now, in some situations, you can actually negotiate with the seller to credit you to cover the cost of closing costs, but you will still need to have at minimum the cost of your down payment. Now, there are some situations where you can finance it through down payment assistance. And in most situations, I strongly recommend about $10,000 to be available to you to purchase a property. And the reason why 10,000 is a good number is because if you use the down payment assistance program, you should be able to get in with 10,000 with not much credit from the seller. But if you have $10,000, you're going to have to put what they call an earnest money deposit down on the purchase of the house, which is basically you saying, hey, I'm serious about making an offer in this house. Here's a deposit on the purchase of this property. Those deposits are typically about 1% of the purchase price. So if you're buying a house for $400,000, you need to put up $4,000. They're going to cash the check immediately, so the funds need to be available, and it's going to be held by the title company, and it's going to be used towards the down payment or closing costs in the future. The second thing that people have to be aware of is you're going to be paying for inspections. This includes your appraisal, which is required for financing, but then additional inspections if you would like them. So, Roxanne, can you explain the other inspections that
Yeah,
somebody
so
might need?
there's also termite inspection and maybe mold inspection as well. So the main home inspection, I would say, is something we highly recommend. You do as a buyer when you enter a contract with a realtor to start showing you homes and to represent you in the purchase of your future home. It does state right there of inspection advisory, so that way you kind of have an idea of what that encompasses as well and what other inspections in general are recommended. But I would say yes, so home inspection highly, highly recommended.
Yeah. So, home inspection is what I was mostly wanting to talk about. It's not recommended to go without it, but it's not required. An appraisal would be required, but home inspection really does a really good job in going top to bottom, left to right in the house. They check all the sockets, all the plumbing, all the electrical. They check the roof. They check the grading in the house. They do a lot of things because, let's be honest, most people are not that good at looking at all of those things,
Right.
so it's good to have a professional there to give you a written report and to give you an idea of the condition of the property.
Right. Yeah, that's very important. Again, like this, I always stress the importance of a home inspection for any buyer because I guess it might be one of the biggest investments that you make in your life sometimes.
Absolutely.
So it's very, very, very important.
Mhm.
And I would say this could be our last question. All of
Okay.
the questions are the most common that I've been getting and also seeing. So what happens if, let's say, you buy a home with FHA loan and then you decide to sell in maybe like a year or two? Does that loan type, does that affect anything with the sell?
No, there's no prepayment penalties on any of these loans that we offer, both conventional as well as FHA. There are some investment property loans that have prepayment penalties, but that's not really for this conversation. So if you live in the house as your primary residence and you decide to sell it and purchase something else, the only thing you should be really worried about is something known as capital gains. Capital gains means in a short amount of time, less than 2 years, you've sold the house and you make a profit. If you make that profit, depending on how many months you've owned the home, you may need to pay taxes on that. So if you keep the property for 2 years or greater and you sell it and you make money for a single person in California, I don't think this would change this much in our area, but maybe in some other areas. If you make more than $250,000 on the sale, then you may have to pay taxes for any dollars over 250,000 profit. If you're a married couple, it's $500,000. And that's just the current rules for capital gains.
Right. And then it's also interesting because right now at the moment, I believe the president and the administration is talking about potentially, this is just also rumors, but potentially eliminating the capital gains tax. So we won't know what will happen, but I feel that that's something to also keep in mind as
Well, the
we.
existing rules do show 250 and 500. But if
Mhm.
they do eliminate the capital gains, it could be a huge benefit, especially in the high cost areas. Because if you think about it, if your house went up over $250,000 in a year and a half, that's a lot of change. So, I mean, it's not realistic, but I mean, if you kept the property long enough, yes, the capital gains still stay there. So that is something,
Right.
say, if they've had the property for 10 years and it's gone up over that amount, then maybe eliminating that capital gains would be a huge benefit.
Right. All right. Well, also to end the video, you can also let them know where they can find you. All the
Sure.
videos. I see this video.
So I would like to share my website real quick and then also a QR code if people want to go ahead and take a picture of that. So here's the QR code. Let me go ahead and share this real quick. If you have a need for my contact information, the QR code is here. And I'll leave that for a couple seconds. All right. Now I'm going to take you to our website. And this is where, if you'd like to, you can schedule an appointment to either have a phone meeting, you can do a face-to-face meeting in our office, or we can do a Zoom meeting. Actually, we use Teams through our system, but you would just go and click schedule a meeting. And once you get to this location, it will give you a schedule option, and you can choose to schedule a meeting that's going to be, you know, a home planning meeting. And you would just enter in your email information, but you can do a phone call, you can do an online Teams meeting, or you can come physically into the office. Or if you just want to connect and just have like, hey, I just like to talk to you for 15 minutes. So these have different time frames. And then the calendar's there, you just select a time and date, and then once that's done, it puts it on our mutual calendars. And if you ever have a need to, first talk with, Roxanne, give her a call. And then from there, she can easily set up an appointment using the same method, or she can just text me or give me a call. And feel free to call me, guys, or text me. I'm really try to be very accessible. And if I'm not available, you know,
All right. It looks like it froze a little bit, I think.
okay. So, yeah, I was saying that if there's any need to meet, like I said, just use that resource, or they can call you directly and we can connect and see if there's a way that we can help them.
All right. Sounds good. Yeah. And I'll also go ahead and leave the information in the caption of this video or bio of this video. So that way, if you ever need to reach us, we're located in Kern County, but we also service all of California as well.
Correct. Yeah, I'm licensed throughout the state as well. So if there's anything that you have anywhere in the state of California, feel free to reach out.
Alrighty, so thank you so much, Alan. A lot
Absolutely.
of good information, a lot of great information that I think many people like should be taking notes of. And like any other questions, we're here to help as well.
Awesome.
Thank you so much for doing this video with me and have a lovely day.
Thank you so much, Roxanne. Take care.
Bye bye.